lose money over time. This is not because trading is impossible. The real reason is that most people think and trade the same way. When beginners open a chart, they usually look for support and resistance, trend lines, indicators, or candlestick patterns. They believe that if price breaks above resistance, it is time to buy. If price falls below support, it is time to sell. These ideas seem logical because they are taught in books, online courses, and YouTube videos. But here's an important question. If millions of traders are using the same methods, why do most of them still lose money? The answer is simple. The market is not just about patterns on a chart. Every candle represents real buyers and sellers placing orders. Professional traders understand this. Instead of focusing only on chart patterns, they study the behavior of the people behind those patterns. One of the most important ideas they understand is liquidity. Liquidity simply means places where many buy and sell orders are waiting. Large institutions need liquidity because they trade huge amounts of money. If a bank or hedge fund wants to buy millions of dollars worth of an asset, it cannot simply place one large buy order. Doing that would push the price up immediately and give them a poor entry. Instead, they look for areas where many stop losses are already waiting. Those stop losses provide the liquidity needed to complete their orders. The same thing happens when they want to sell. They need enough liquidity to take the other side of the trade. This is why professional traders pay close attention to liquidity instead of only watching chart patterns. Let's look at a simple example. A trader sees a strong swing low and decides to buy. To protect the trade, they place a stop loss just below that low. Thousands of other traders do exactly the same thing. As a result, many stop-loss orders collect below that swing low, creating a pool of liquidity. Price may suddenly drop below the low, triggering those stop-losses. Many traders panic and close their positions. Then, just as quickly, the market reverses and starts moving higher. Many beginners call this manipulation. In reality, the market simply moved toward an area where many orders were waiting. Now imagine price has been rising for several days and reaches a well-known resistance level. Everyone is watching it. Social media is talking about a breakout, and many traders are waiting to buy. The breakout finally happens. A strong bullish candle appears, and excitement spreads. Retail traders see a buying opportunity. Professional traders ask a different question. How much liquidity has just entered the market? They know that many breakout traders have just placed buy orders, creating fresh liquidity. This doesn't mean every breakout will fail. Many continue moving higher. The lesson is that successful traders don't follow signals blindly. They first understand what is happening behind the move. Retail traders focus on candles. Professional traders focus on trader behavior. Retail traders ask where price might go next. Professional traders ask where the orders are waiting. That simple change in mindset is one of the first steps toward thinking like a professional trader instead of following the crowd. Once you understand liquidity, you begin to see the market differently. Instead of chasing every price movement, you start asking why the market is moving in the first place. This is one of the biggest differences between retail traders and professional traders. Most beginners try to predict where price will go next. They spend hours looking for the perfect indicator or the perfect setup. They believe that if they can correctly predict the next move, they will become profitable. Professional traders have a different mindset. Instead of trying to predict every move, they study where traders are placing their orders. They know that large market moves often begin around areas where liquidity is waiting. Imagine price has been moving between support and resistance for several hours. Many traders expect a breakout. Some place buy stop orders above resistance, while others place stop-loss orders below support. Both areas now contain a large number of pending orders. Professional traders know these levels are important because they contain liquidity. Sometimes the market moves into one of these areas first, triggers those orders, and only then starts a real direction. That is why patience is so important. Many beginners enter too early because they are afraid of missing the move. Experienced traders are willing to wait until the market reveals its true intention. Another important tool professionals use is volume. Price tells you what the market has done, but volume tells you how much participation was behind that move. Think of it this way. Price is the result, while volume is the effort. If price rises with healthy volume, it usually means many buyers are supporting the move. But if volume becomes very high and price barely moves, it can mean large buyers and sellers are trading against each other. One side is absorbing the other. This can be an early warning that the current trend is losing strength. For example, imagine the market has been falling for several days. Fear is everywhere, and many traders are selling. Suddenly, volume becomes extremely high, but price stops falling. This may be a sign that large buyers are quietly buying everything that frightened traders are selling. This is often called stopping volume, and it can be an early clue that selling pressure is fading. The opposite can also happen. After a long rally, excitement grows, and everyone wants to buy. Volume increases sharply, but price struggles to make new highs. This may suggest that professional traders are selling into the buying pressure while retail traders continue entering the market. Another useful clue is volume divergence. If price keeps making new highs while volume keeps falling, the trend may be losing momentum. The same idea applies during a downtrend. If price makes new lows while volume becomes weaker, selling pressure may be fading. No single signal guarantees a winning trade. Professional traders combine different pieces of information. They study liquidity, volume, market structure, and trader behavior before making a decision. Their goal is not to predict the future perfectly. Their goal is to find high probability opportunities while managing risk. Once you stop chasing perfect predictions and begin focusing on probability, patience, and discipline, your view of the market starts to change. That is when you begin thinking more like a professional trader. Understanding liquidity and volume is only part of becoming a better trader. Knowledge alone is not enough. What separates successful traders from struggling traders is having a clear plan and the discipline to follow it. Professional traders never open a chart and enter a trade without preparation. Before the market opens, they identify important price levels, liquidity zones, possible entry points, stop-loss levels, and profit targets. They already know what they will do before the opportunity appears. Before entering any trade, ask yourself a few simple questions. Where will I enter? Where will I exit if I am wrong? Where will I take profit if I am right? How much money am I willing to risk? Once you have those answers, your job is to follow the plan instead of making emotional decisions. This brings us to one of the most important lessons in trading: risk management. Many beginners spend all their time searching for the perfect strategy. They believe one great setup will make them successful, but even the best trading strategy will have losing trades. Losses are part of trading. The goal is not to avoid losses. The goal is to keep every loss small enough that it does not damage your account. Professional traders always protect their capital. They decide how much they are willing to lose before entering a trade, and they never increase that risk because of hope or emotion. Beginners often make the opposite mistake. They move their stop loss farther away, refuse to accept a loss, or add more money to a losing trade. These habits usually lead to much bigger losses. Another habit that helps professional traders improve is keeping a trading journal. After every trade, they record their entry, exit, setup, emotions, and final result. Over time, this helps them spot mistakes and improve their decision-making. A journal may show that you often enter trades too early, ignore your trading rules, or let fear and greed influence your decisions. Once you identify these habits, you can begin to correct them. Trading psychology is just as important as technical analysis. Every trader experiences fear, greed, excitement, and frustration. The difference is that experienced traders do not let those emotions control their decisions. They trust their trading plan and understand that no single trade determines their success. Trading is a game of probability. No strategy wins every time. Even the best traders experience losing streaks. What matters is following a proven process over many trades, not judging yourself by one win or one loss. Patience is another quality every successful trader develops. You do not have to trade every day. Sometimes the best decision is to wait until the market presents a high-quality opportunity. Waiting for the right setup is often more profitable than forcing a trade out of boredom or impatience. Let's finish with the most important lesson. Most traders lose because they follow the crowd. They chase obvious signals, ignore market context, and allow emotions to guide their decisions. Professional traders think differently. They study liquidity, understand volume, manage risk carefully, and follow a disciplined trading plan. Your goal is not to predict every market move. Your goal is to make good decisions, protect your capital, and stay consistent over time. The day you stop thinking like the crowd and start following a disciplined process is the day you begin your journey toward becoming a professional trader. Thank you for watching, and I will see you in the next video.